Welcome, everyone. Thanks for joining us for this month's ClearVista Financial Perspectives, our March market update. Mark Trice, I'm founder and lead advisor with ClearVista Financial, here with Jesse, Jesse Hamilton, who's also an advisor here in our office
Hey,
as
everybody.
well. So a lot has been going on, Jesse. Of course, I hope you know what today is. It's the 189th anniversary of some of your very famous fellow Tennesseans dying
At the Alamo.
at the Alamo. I saw the live updates this morning when they have dawn at the Alamo ceremonies every year, and
That's kind of cool.
there's some cool announcement that came out of there. They found the original limestone quarry
Wow.
where the stones came from. Anyway, we remember the Alamo for us Texans, and some Tennesseans should too. But we're glad you've joined us. Today, we're going to kind of get into a lot of stuff. We're going to be talking about performance in the indexes in February. It was a down month overall. And we'll talk a little about tariffs, Doge, not the EFT, but Doge or coin, but Doge, the Department of Government Efficiency, and other things that are going on in our country right now.
I had a good laugh preparing the slides this week. I typed in Doge as the title,
Yeah.
and it just spit out all these AI images about dogs,
Oh,
which
really?
was hilarious.
That
But
is funny. Let's get started.
unrelated,
What's our agenda today? Go
let's
ahead and
dive
jump
in
into
here.
that. Yeah.
So we're gonna do our index performance as always. We'll do our macroeconomic update where we talk about the current situation. We'll get into the government some there, and then we'll talk about how it might impact you. As always, send us a text 254-282-0495 or an email info@clearvistafinancial.com. We'd love to interact with you live right now, or later on when you're watching or recording, just shoot us a message and we'll try to answer your question.
Right.
First up is the S&P 500, which is our large cap index, big companies in the US. As a reminder, this is called a candle chart, where each candle represents a trading day. Green is a positive day and red's a negative day. And the stem is kind of where the price went throughout the day. So during the month of February, this index was minus 1.27 for the month as at the close last Friday. But as you can see, Mark, we had some volatility throughout the month. It rose for the first 2 weeks, and you'll see a peak there on the 19th, and it fell all the way down to the 28th, as low as 5.02%. A lot of this has to do with investor reactions to the news and things going on, but
Tariffs.
yeah, tariffs. And we'll talk in a second as a reminder of how heavily weighted this index is toward the really big companies.
And the market's continued south for the first week of March so far. We're doing our um, we're doing this webinar obviously on the 6th of March, and there's been a new announcements and things, and I think that some interesting trends are starting to emerge.
That's right. Next up, here's the NASDAQ 100, our tech-heavy cap-weighted index that does not include financials. And as expected, as usual, it behaves similar to the S&P, but with more volatility. The index closed minus 3.95, but check out the swing here from that peak, 8.64%. And most importantly, ever since this chart, this week, Mark, as you said, the new data that we're watching today, we saw this index drop below the 200-day moving average. And can you tell them why that's important?
That's important. That's usually a signal of the momentum of the market. Now, will that stay that way? We don't know. But basically, what's happened since this month and really in January as well is that we've basically retraced all the gains that took place after the November 4th election. And so that's important to realize that we have these swings and there's a lot of upticks. And Jesse's going to talk in a minute about volatility. This little correction, not really a correction yet, but a little bit of pullback is actually normal for this time of year. Historically, we see a little bit of pullback in the first couple of months of the year, and this one's no different.
That's right. And we don't know if this trend will continue, but over the past month, we did see a shift from the big companies in the tech sector rotating out of that into other asset classes that are outperforming. So we'll continue to watch that closely.
And outperforming is a relative term. It does not mean that they're making
Yeah,
money necessarily, just means
losing less.
they're losing less or making a little bit money.
Here's the Russell 2000, our small cap index. And notice how this is trending down through the month. So a little bit different pattern. And the index closed minus 5.22. And then that swing from peak to trough at the end of the month on February was 8.56%. So that's some serious volatility. Pretty, like you said, that's almost normal for small caps to swing that much. But unlike the large caps, this index did fall below its 200-day moving average in the middle of February. So February 21st, we fell below that long-term marker for support.
And I think the two big things that really affected all indexes this month for the month of February were two things. The minutes from the Fed meeting came out and they showed how steadfast the Federal Reserve is about not cutting interest rates too quickly. That will be important to analyze, and then also to those things impacted borrowing costs, and a lot of small cap companies tend to borrow more money than large cap companies. And then, of course, the tariff discussion. So those are the two big issues in February that are impacting markets.
So here's long-term bonds, our long-term treasury bond index. And surprisingly, this was actually positive for the month. So this just means that over that short time period, the yields have been dropping. We're glad to see that. The price of the long-term bonds is going up. The index actually closed plus 5.32, which that might be crazy to some of you listeners that are like, bonds don't change in value. Yes, they do. Especially the long-term ones, they do dramatically. And we're also dealing with the 200-day moving average here, but the other direction. So
So
whereas the equities are bouncing on the bottom, the long-term treasuries are hitting it at a top. And so they're facing resistance the other way. And that
and
just,
actually, this week the yield started rising again.
yeah. So they bounced off that number and then they're going back. The value here on the chart's going back down again. And yeah, we've not seen it rise this week.
Yeah. Okay. Great. What about the moderate index?
Yeah, real quick touch on the moderate index here. Notice how it's basically sideways. We saw very little change throughout the month. It was positive 0.88, but that's a day's inflection for this index. So really, really no movement at all. We're combining the equity losses we talked about with some fixed income gains. Not all bonds did well. And at the end of the day, we kind of just scooting sideways throughout the month.
Of course, our disclosures that we have to give to you about indexes and things, we really need some theme music for our disclosures so
Yeah,
that we
read
can.
these in great detail and contemplate on them, but let's move on. Here's the volatility that Mark was referencing over time. So I believe this is at least 20 years of data for the S&P 500. Notice where the red arrow is pointing. That's the beginning of March. We actually see the highest volatility for the entire year during this springtime. And you could come up with 1,000 reasons why that's true, but and that doesn't mean that we're headed for a dramatic shift one way or the other, but historically, this is a time where the price moves a lot.
Yeah, and it's not to be a cause and concern. The seasonality happens almost every year. And I think some of it has to do, Jesse, with just the fourth quarter earnings being reported
Mm-hmm.
in March and into February. And so we see that volatility increase. And then typically things settle down toward in April and May and really are low in July for historically seasonal type activity and volatility in the markets.
Because all the traders pack up and go to the Hamptons, right?
Yeah, there's that old adage of sell in May and go away. Well,
Yeah.
some of that happens in July, yeah.
Just a reminder here, I brought this up last month, but we're dealing with a historically top-heavy index for the S&P 500. Several companies are approaching and exceeding the $3 trillion valuation for one company. That's bigger than the entire Russell 2000 index combined. So that's the kind of top heavy weighting that we're talking about here. And this applies mostly to the S&P 500, those top 10 companies represent 40% of the index value right now. Historically, that's more in the 20 to 25%
And this
range.
this is kind of important, Jesse, because it really makes those 10 companies move the market. What happens to those 10 companies moves the entire market. And so we have never seen that before. That's been a kind of the recent, the last decade phenomena that you have such a high concentration of a few companies that make up the bulk of the
Mm-hmm.
size of the market. And that's something I think that um, the indexes are going to have to address at some point. NASDAQ or the NYSE may have to reevaluate how those things
Yeah,
have such a big impact because, one of these companies reports earnings and they're not as exciting as they hope. Market's disappointed.
that's right.
So I think we're going to talk about price to earnings ratio in just a few moments, but yes, the market could be influenced and moved by just a couple of companies.
Yeah, if we did some indexing with a client and we said we're going to put your money in the S&P 500, a lot of people would say, "Great, diversified." Not really,
Not really.
but they would think that. But then if I said, "Let's put 40% of the portfolio in 10 companies and then 490 companies in the other 60%," you'd be like, "That's crazy. That's not diversified at all." That's what the S&P is right now.
Yeah.
So just as a thought exercise, that's what we're dealing with. Another reminder, this is a slide from a few months ago as well, but for those of you who are a moderate style of investor, this is our moderate index over the last 4 years. It kind of tells the story of why you might not be as exceeding these index returns if you pull up the news and last year the S&P is doing 20+% and you're moving sideways. What is going on? Here's the historical prices. We had COVID, we had the stimulus rally because we all had money in our pockets, and then the painful year 2022, the bear market comes, drops back down. 2023, we're moving sideways, we're volatile, really until the very last 2 months of the year where it rose up a little bit and caused a positive return for the year. We bring in the idea of artificial intelligence and the Magnificent Seven or 10 companies just outperforming by a huge margin, which rose all the indexes. And then at the end of 2024, we kept moving sideways. But notice this red line here. That's where we closed last year and how it's not even close to the high that we were used to in 2021.
Yeah, we still have not recovered that. So your portfolio, if you're not working with us per se, may not have recovered from 2020, 2021, really.
Mm-hmm. And unless you have all of your investments in equities, Nasdaq, S&P, you're not gaining what the news is saying.
Right.
You're kind of more along the lines with this.
Nor
So
should you, because we're
no,
not recommending that
no,
you go
no.
that risk, have that much risk tolerance
Just
to
wanted to
this.
have a quick reality check on
Yeah.
on a lot of investors in our country. So we'll pause for a second. A reminder, you can communicate with us here, 254-282-0495,
And we'll
or
try to answer those questions on the webinar today, if possible. If not, we'll get back with you in a few days
that's right.
to answer those questions. Not seeing any questions on the chat line or text line, if you will. But let's go ahead and move forward and jump into more of a macroeconomic review here.
Yeah, so here's just a few high-level points I wanted to bring up. The first is the Fed didn't meet. We got to hear the minutes, but they didn't meet. We're still dealing with this ambiguous wait and see from January. Most investors, in our experience, are still expecting 2 quarter-point cuts this year.
That's down from a previous prediction
Mm-hmm.
of several cuts this year, amounting to maybe 2%. And the Fed is signaled that we're not going to see that.
Yeah, so here's all the crystal balls from all the big analysts, which they don't know anything more than we do, but this is what they're predicting moving forward. Some of them see 0 all the way up to 1.25%. We don't know what to expect, but obviously a couple of these groups are very optimistic.
Yeah, Citigroup's kind of involved with some of the treasury stuff. Be interesting to see what if their prediction comes out, but that's really aggressive. rate cuts. Although we did see today that the European Central Bank cut their overnight Fed fund, or funds rates. I can't remember the exact amount, Jesse, but their economy is also a lot weaker than the United States.
Mhm.
So, I think it's prudent for the Federal Reserve to wait and see how the data comes about. We know we had an initial jobless claims report come out this morning, and it was actually better than folks anticipated. Although we are seeing a lot of layoffs in the federal government, which we'll talk about in just a minute.
Here's a visualization of where we came from and where we are now. You can see the historic rise in interest rates from the Fed in 2022.
Unprecedented,
Unprecedented.
unprecedented, and ended a 40-year bull market in bonds.
That's right. They stayed flat there for most of 2023, and then they began to cut. And everybody wants to talk about, yeah, we're making progress, but look how much progress we've made in reality
Right.
comparatively.
And the Federal Reserve is doing all sorts of quantitative easing, different types of things to reduce their balance sheet. But I think what's interesting, we don't have a slide on this year, is it's likely that you actually may see once the GDP reports come out in April, very likely you might see a slight contraction in the economy for the first quarter. Not surprising, but the potential to have a slight contraction in the first quarter. That's not a recession, although the R word is coming up more in the news,
Yes, it
but it's
is.
more, I think, sensational than anything to
In
get a
fact,
click on.
I saw the R word on the front page of the Wall Street this morning.
Right.
I don't know why they're talking about it. It just makes people scared.
Makes people scared and wants to look for things. Click on the article. Yes. Okay.
They got me to click on it. So
See, you fell for it.
here's the historical Fed funds rate, just for some perspective. I've been showing this for a few months. That's the far right is where we are today versus back in the 70s and 80s. And then you see the 2009 to 2017 0% rate, which we all got used to, right? We love that time. You can get a 2 or 3% mortgage, and just look how unrealistic that is historically.
Well, and so what's interesting here, because I know a lot of young people that are trying to buy homes or maybe a new car and so forth, are just outraged that they're paying, just under 7% for their 30-year mortgage. And the folks of us from Gen X and the baby boomer generation are quite familiar with those very high mortgage rates from the late 70s, early 80s. And what we have to realize there is, yes, housing did slow down, and you're seeing that as well in some data we're going to share with you in just a minute. But it didn't crash the economy. This is
Mhm.
not anything. These rates where they are now are actually pretty normal for overall rates.
Yeah. Here's the yield curve that we always show. And on the far left, we see the short-term bonds from the government. And the far right, we see the long-term bonds. We'd like it to be low on the left and high on the right in kind of a hockey stick shape. It was getting there. We were making progress. And then this last month, the short-term yields actually popped up again. So now we're looking at kind of the horseshoe shape.
Well, and usually when you see the yield curve and reinvert the way it's supposed to be, you're going to have a lot of volatility in the market. So this is going to continue for a little while until things settle down, but it will.
Yeah, and the horseshoe shape is just not sustainable. So we don't expect that to be there for long, but it's going to cause volatility for it to
So
change.
so in this case, short-term interest rates are still looking good.
Mm-hmm.
Yeah. So make sure if you have CDs and things and they're up for renewal, make sure you're
Lock it
looking
in.
around and locking in those short-term rates.
So this isn't an exhaustive list, but let's just cover a couple of leading indicators here in the economy. First being existing home sales. They declined 4.9% in January. They really continue to struggle, Mark. And one of the main factors is the 30-year fixed mortgage, like you said, briefly average rose above 7%. And that just makes it more challenging for people to buy existing homes.
But I did talk to our mortgage banker friends, and they have seen applications for refis and new loans pick up quite dramatically in the last few weeks in the month of February, mainly because those rates fell briefly below
Mhm.
7% and people jumped on it.
Of course, we get this data 2 months later,
Mm-hmm.
so February might look better than
Mm-hmm. It
January.
might, yeah.
But home prices are rising. The median price of an existing home up 4.8%. And yeah, that the higher end of the market is where we're seeing people adjust to this reality.
Yeah.
The people who can really afford the bigger, nicer homes, those are the ones that just saying, you know what, let's just do it.
Right. Right.
What about new homes? Same kind of story here, but
Yeah.
more
Same
dramatic.
story, more a little bit more dramatic. New homes, and this is reflection of what builders kind of see as their forecast for the future. And interest rates do affect how quickly they are able to move inventory, but those declined in January as well.
Yeah, the good news here though is that median sales prices of these new homes did fall a little
Yeah.
bit, about 3%, which is good if you're trying to buy one. And we are seeing more small properties. Not That does not mean that there's a lower price per square foot, but smaller, newer properties. So maybe more accessible to
Yeah.
people wanting to buy a new
Yeah, and
home.
those are good things. And builders are actually making concessions.
Yeah. So, like I said, these are leading indicators, meaning we got negative data on both these last two slides. That's a leading indicator that maybe we're slowing down in the economy.
Yeah, just a little bit for sure.
And our third leader here is retail sales, which declined 0.9% in January. Not a huge decline, but US consumers did pull back in the first month of the year. And the sales are declining by the most in nearly 2 years,
2 years,
which
yeah.
is a lot.
It just people are uncertain about what the future holds. All this talk about tariffs and things
Hmm.
are concerning people. So maybe some people are holding off on significant purchases.
That's right. In January, we had bad weather, we had wildfires, we had lots of ugly things going on. So it kind of makes sense why
Yeah.
people didn't spend nearly as much retail money. Let's talk about the current administration. Mark and
Okay.
I had some really good feedback from three of the leading economists in the entire industry at the Kingdom Advisors Conference last 2 weeks ago, where we got some great insights, and we'd like to share some of those opinions with you. So, first up, Mark, you mentioned the price earnings ratio.
Yeah,
Historically, that's when it gets above 20, that means that the market is expensive.
that's right.
And right
And
now it's 27.
27%, meaning that the price of stocks is about 27% above its earnings, 27 times its
27
earnings
times the earnings.
in earnings. And that in most situations is expensive, but that does not mean that it has to return back to the 20x level for the market to continue to grow.
That's right.
The market can continue to grow. It's just saying that, look, there's some caution here. These stocks are expensive, and a lot of it was driven up by those large cap companies that we talked about.
Yeah, but our point here is that a new administration can do nothing about that.
That's
That's
right.
the behavior of the market.
That's right. It's not a policy driven type situation. So let's talk a moment about tariffs, though.
Yeah, they could generate tail risks on both ends. So if we have a little graphic, if you can see my hands, in the middle we have American success, right? American prosperity. And then we could maybe drift off one way or the other on the negative side of things. The negative side is unleashing global stagflation, and maybe the US suffers a little bit. This is maybe a realistic situation where the tariffs do cause stagflation, which I'm sure Mark would love to talk about in a second, but that's not good for us over time. And then that might cause the US consumers and citizens to suffer a little bit.
Yeah. And we had this back in the 70s,
Mm-hmm.
as a result of the high inflation. We eventually slowed down and there was a little bit of stagflation. But talk
Yeah.
about the positives, though. What
Yeah,
can
we could
happen?
also drift and fall over to the positive side, which is where these new deals and new accords lead cyclicals up and financials higher. So not these super high flying mega cap techs high flying high, but actual value
More value
stocks
stocks. Yeah.
rising up and creating value in the breadth of the market for all the investors. That's good for everybody, and we would love to see that.
Well, and I think it's important to the tariffs have been getting a kind of a bad rap
Yeah.
in the media lately because a lot of the media will go back to this the last time we did this it was awful, and what they're referring to is the Smoot-Hawley Tariff Act in the 1920s, and it was a situation where the federal government was trying to raise revenues, and this time this is completely different. We're always having trade wars with other trading nations. The United States has been behind the eight ball for generations when it comes to trade. And these tariffs are to basically try to level the playing field for American companies and American businesses, and thus will impact American workers and hopefully in a positive way over time. But as a result, there are short-term risks. In fact, in President Trump's address to Congress on Tuesday night, he talked about there'll be bumps along the way. But what you're seeing is that these countries that the tariffs are being put on, they're coming to the negotiating table because they don't want the tariffs any more than we do.
Mm-hmm.
And they're talking about these things right now. I know Canada's Prime Minister Trudeau was on the phone with President Trump yesterday. The president of Mexico was actually both of these countries sent emissaries to Washington this last couple of days, trying to negotiate things. They may get it on television and scream this is not fair and we're gonna stick it back to America, but they're scared and they know they have to make concessions if they want to continue to prosper with trading with Americans. So
Mm-hmm.
yes, there will be bumps. There's lots of policy changes that are coming, and none of this is going to happen overnight. We'll talk in a minute just about some of the spending cuts that might happen. There's a lot of rumors about that.
Yeah, there are.
And then, some potentially new tax legislation that may come around or at least get extended from the
Right.
2019 Tax Cuts and Jobs Act.
Unfortunately, we do expect a delay on that because there's a lot of negotiating and concessions that have to happen on both sides for it to make its way through to eventually make it to the president's desk. So that might take a while.
Sure. Let's talk a little bit about Doge, everyone's favorite conversation in the media. Now, Doge is that Department of Government Efficiency that's headed by Elon Musk.
The new liberal supervillain, Elon Musk.
Yes, he is the new supervillain in Washington, D.C., not very popular with the folks inside the Beltway. He is making a lot of suggestions and changes. Now, the Supreme Court handed him a little bit of and President Trump, a little bit of a setback this week, saying that a lot of these cuts can't be done at the executive level. They have to be put before Congress. So that may change how quickly some of these changes are. But having lived in Washington, D.C. for a number of years myself, I understand how important the federal government is to that economy. But quite frankly, it's been alarming to see some of the things that have been uncovered. And President Trump went through some of those things in his speech to Congress this week, and it was very interesting to see some of the things. But potentially, Doge says there could potentially $1 trillion worth of savings in the federal budget that could be eliminated. Now, how much of that is true? I don't know. But we have seen reports, conflicting reports, mind you, of people that are actually on the Social Security rolls, receiving Social Security benefits that are actually older than the United States. And
Yeah,
several people, I mean, millions of people that are over the age of 120. I know, do you know any 120-year-olds?
no.
No, no, none of us really know a 120-year-old, but they're still getting Social Security payments. Those types of fraud and abuse need to be addressed, of course. But the idea of trying to eliminate Medicaid or Medicare or trying to alter Social Security in a significant way are just not true. They need to be affixed and addressed, but that's not part of the Doge conversation. Jesse,
Mhm.
you might throw out some of the numbers here for this,
Well,
just kind of let people know.
these are agencies that spent the most on canceled contracts last year. So it's just a graphic that the Wall Street,
Cancel contracts. So
yes,
money that should not have been going out.
yes, that did. So this is what the Wall Street Journal found, but the biggest one here is US aid, 1.2 billion. And there's kind of different colors for different types. The big one just says other because they couldn't identify what it was, but you can see environmental is the darker green, and then the really dark green piece at the top is DEI, money that was spent on that. Um, Not a super helpful graphic here to debunk all the
But
rumors going
it's
around.
really interesting that this was just wasted money that was paid out to contracts that no longer existed.
Yeah,
I mean, they might as well just take this money and put it on the Washington Mall and
take a
burn it.
bath.
And burn it because that's what they did. Someone benefited from this, but they weren't supposed to. So it's going to be interesting to see how this all pans out and things. But I think there's, when it comes to tariffs and Doge and things, there's people are concerned that's going to impact their portfolios. And so you have to ask yourself, and we sent this letter out to our clients actually last night. You have to ask yourself, if you're nervous, should I get out of the market now? How will I know when to get back in? And I can guarantee you, no one knows when the optimal time to get back in is. So, do you stay invested in the long run? You should. And we still stand behind that philosophy despite short-term volatility. Another question we put in the letter that we sent to clients, and we're happy to share this with you if you did not get it. Would I rather miss a short-term correction that lasts for maybe a month or two and miss out on a rebound that lasts for several years? Because this is the problem. We've seen this in our business. Jesse, I remember people that just couldn't handle it in 2009. It was a scary time,
Yeah,
2008, 9, got out of the market, put everything in cash, and they still are in cash to this day. They've missed out on over 500% gain in the S&P over that decade and more.
probably could have tripled their money.
They could have, and that's sad. When you jump out because of fear, you lock in losses.
Mm.
You lock in losses, and sometimes you lock in gains, but you also can lock in losses. And the fear to go back in, most people make the mistake. They decide it's time to get back in when the market's up 50%.
Yeah.
And that's not the time to jump back in.
Mm.
Okay. So how does this all impact you?
Yeah, we have tariffs, we have tight monetary policy that is tighter than we're hoping for. Somewhat resilient markets aside from the pullback in February. Potential stagflation. What does this all mean to you at the end of the day? And of course, we don't have a crystal ball. We always say that. We don't know what is going to happen in the future of the markets. We have data coming in today, and that's going to help us make decisions about the future. If a recession comes, that's okay. We believe that a recession is a healthy part of the business cycle. It's actually needed. And when a recession happens, we have hope for it to rebound. That's normal.
And some things do better during recession. So
Hmm.
it's not a gloom and doom at all. I don't think we're going to go into a deep recession here. I think we've already been in a manufacturing recession for some time, but you don't really see it that much.
Hmm.
And I think the overall economy may retract a little bit in this year, but I'm not too worried about that because of the health of the economy.
So here's some high level points as we kind of wrap up today. We're still waiting on the wait and see. What does that mean from the Fed? Market breadth is not improving. We're seeing even a further spread between big companies and small companies. Bond indexes might have done well in February, but they're still struggling.
Yeah.
Interest rates remain high for people who are trying to make housing moves. Credit card debt is historically high. Money supply is low because we're running out of the cash that we had saved up for the past 5 years. Political pressures, tariffs, lots of things going on right now.
Jesse, you're making me depressed, but we shouldn't be depressed,
No,
right?
no.
So what do we do here?
My point here is that we don't need to make decisions based on what the headlines say.
Right. And I think it's, I think the headlines are horrible.
They are.
I mean, they're just clickbait. They want you to tune in or, see the news story at 11 or click on the link for that particular article. But it's so important that we remain calm. I mean,
Mm-hmm.
this is important to stick to your strategy if you have a strategy. If you don't have a strategy, please call us. We need to talk. But
Please, yeah, please avoid political bias in making your financial decisions. And I encourage you that if you're receiving all of your news from one place, get a well-rounded perspective on what could actually be happening from different sources.
and we hear all sorts of, I'm gonna say it, crazy things that are gonna happen,
Unfortunately, we do.
and it's all from different shows and news sources that don't have your best interest at heart. And don't believe everything you read or hear, because that's how media companies make money.
Mm-hmm.
They want to get you upset, raise your blood pressure, and a lot of times it's nothing at all.
Let's be very clear here, Mark. We're not trying to be gloom and doom. In fact,
Absolutely not. We
we
think
think the
very
future
positive.
is very bright.
Yeah, we're very positive about the economy and the markets and things.
There are places of value right now in the markets. There are opportunities for bonds to rebound. There are opportunities for you to stay invested and reap those benefits over the long run. 1 month is not going to make or break your investment portfolio. So we want you to have that long-term perspective, and we feel good about the
Or
future.
even 1 year
Yeah.
is not going to break that.
Quick comment here, as we always say, what about my 401k? A
Yes.
lot of you listening today, this is the biggest piece of savings in your entire portfolio. You've been stashing away in your employer for years. You need to take care of it, whether that's getting professional help or educating yourself on how to make those selections. We need you to focus on this because it's diligence is required with this big piece of your portfolio.
And please note that just because you've signed up for a quote, I'm using my air quotes here, management service with your 401k is not being managed. It is being basically put into a target date fund. So folks, in many ways, you're paying money for something that you could do yourself very easily. And we're happy to help you. We have tools available that will help you diversify and properly allocate your portfolio that's in line with your values, in line with your tolerance for risk, and what your financial goals are. Don't
Right.
rely on the 401k providers. I mean, we see this all the time, and it's just an easy way to fall asleep at the wheel, and we don't want that.
We have a great tool. I won't go into detail about it, but it actually has stop losses with the market. So you can have some reassurance that there is a group watching and analyzing it on your behalf. So if you're interested at all, give us a call. We're not going to charge you a bunch of money to use it either. It's a very inexpensive tool. So at the end of the day, what does it mean? Well, March is here. We're moving faster than ever before. The year doesn't seem to be slowing down. But our same 3 points here as we wrap up. Check your statements. Don't be afraid to look at your statements for your accounts. Talk to a professional. Get some professional help and educate yourself. Get a well-rounded perspective on what's going on in our world right now. I hope we've been able to provide some of that to you today. Mark, we got any questions from listeners?
I'm not seeing you on the chat line, but as always, send us a question, 254-282-0495, or you can send us an email at info@clearvistafinancial.com. We will get back with you shortly on that. But Jesse, thanks for the material that you presented today. And folks, we thank you for listening in. This recording will be available on our website within a few days, probably week after next. But you can watch it again anytime on our website, ClearVistaFinancial.com. Folks, thanks. If you have any questions, let us know. We appreciate you listening to this ClearVista Financial Perspectives.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.